Commodities markets. We've got a great voice to do that. Jason Schenker is with us. He's president of Prestige Economics, chairman of the Futurist Institute. I should point out that Prestige has been ranked #1 by Bloomberg News for its accuracy in forecasting U.S. jobs, a lot of commodities. You've really hit it right. So good to have you with us. So, Jason, we are focused so much on the commodity space and what the impact of China will be. Do you think that is the most important story for 2023?
Yeah, I think, Carol, this is the story of what happens with the global economy. How do we see things slowing as a result of the higher interest rates for 2022? What is the price we pay for that in 2023 in terms of slower growth, and especially for things like business investment, construction, and housing, things that will impact commodity prices? And then do we see things in the second half of the year become maybe a bit more optimistic as market participants begin to eye the potential for Fed rate cuts once we sort of top things off probably in Q1.
Okay, so what gives you the confidence, at least according to the data that you're looking at, that we'll start to see cuts in 2023 from the Federal Reserve?
Couple of things. First off is that we do expect we're going to see business investment continue to contract quarter after quarter after quarter. We also believe that inflationary pressures are going to ease. Obviously, the recent drop in natural gas could be something that's going to be positive for that. Oil prices are much lower than they were in the middle of in the middle of 2022. We do think prices are going to be up a little bit by the end of Q1 into Q2 as we see seasonal ramp up for summer driving demand. But we're still going to see year-on-year oil prices down a lot. So if a lot of the inflationary pressure begins to come off and we continue to see a business investment recession that risks spilling over into a general U.S. recession, those factors, coupled with all the layoff announcements and a potential softening a bit of the job market, could give Fed license to look at cutting rates by the end of next year.
I want to ask you, you said softening of the job market. This is something that we all have talked about, right? Romaine, Tim, and I, about this possibility of having a recession with still somewhat of a strong labor market. Do you buy that?
It's what we're seeing, right? You look at the data, you're going to have, we already have like all the unemployed crypto bros in the world, and yet not enough truck drivers, nurses, people working in trades, and many other open occupations. So there's a real bifurcation between where we're seeing big layoff announcements, how that's playing out, and the fact that there's still a lot of open jobs. So as we go forward into the year ahead, before we'd see even lots and lots of negative payroll numbers, we really need to see the number of open jobs begin to continue to fall. We've seen the JOLTS numbers decline. We've seen the help wanted online numbers decline.
Yeah.
They're going to need to decline further, but essentially there's a surplus of open jobs and not enough workers.
But how do you get there, Jason? Because I mean, it doesn't matter the industry. I mean, pretty much every industry is basically saying that they're already either operating well below where they would need to be operating in terms of staffing, whether you're talking about the services industries or even some of the goods producing industries. So I'm curious as to where would the breakdown happen? Is it going to be widespread, or is it going to be in certain industries?
Well, I think we're seeing the certain industry piece right now. We're already beginning to see, obviously, in high tech, these are very high paying jobs. And that, if we look at where consumption happens, 70% of GDP is consumption. If we see some of the highest paid workers, high paid jobs begin to fall off, that's where you're going to see some of the consumption numbers potentially weaken. For the job weakness, what we need to see eventually is that the payroll numbers are just, they might remain modest. We might not see massive negative numbers, but the Fed, if inflation falls, that they would still have license to begin to looking at rate cuts, especially if we see weakness in housing and other financial markets persist.
Jason, we'd all be so rich if we all got some money, a buck every time we said if, because I do feel like there are so many questions for 2023. We don't know what it's like coming out after such, unprecedented global stimulus, right? We've not come out of a pandemic before. We've not come out of an environment where the economy just shut down and then shot up again. So is it safe to say that you and your team are still having a lot of questions? You're playing out a lot of different scenarios because there's just so much we aren't quite sure about?
Well, there are a few things we do feel pretty solid about. We look at some forward-looking data, look at the manufacturing purchasing manager indices. Those are negative right now for China, for the US, for Europe. Those lead industrial metals prices. Those lead economic growth, even though manufacturing is a really small part of the US economy. So Q1, Q2, we're a little bit nervous about downside for industrial metals prices. because we've got the situation ongoing right now in China, the tensions, that Cold War II element, which we see play out in Ukraine and Russia, that's likely to persist. We also see the tensions, the Cold War II tensions between the US and China likely to continue to ramp up. We've seen some of that impact recently with TikTok. If those tensions persist and the capital outflows out of China continue, the industrial metals really see some potential downside, especially in the first half of the year. Oil prices, a different situation. Inventories are tight globally. We could see oil prices move up a little bit, again, based on seasonal dynamics ahead of that driving season. Those are things we feel pretty confident about. And knowing that the Fed is very likely near the end of the rate hikes, that's something we feel pretty confident about as well. We also feel very confident that business investment is likely to continue contracting.
All right, Jason Schenker, a big thank you to you, President of Prestige Economics and the Chairman of the Futurist Institute. Thanks so much for joining us this afternoon on Bloomberg Markets, The Close. Let's get more